Welcome to the Monocle Banking Podcast, curated as always by Monocle Solutions. Anthropic's Mythos model can apparently crack banking security with such ease that Anthropic has decided not to release it into the wild. Banks are beating a path to Anthropic's door to find out more, so I sat down with the South African Reserve Bank's Fundi Tshazibana, she's also CEO of the Prudential Authority, to talk about AI risk and the future of finance. In financial services, artificial intelligence is everywhere at the moment. It's already embedded in fraud detection, in claims processing, compliance monitoring, credit scoring, customer service, risk modeling, cybersecurity. It's everywhere. Some of it is visible to customers through chatbots and digital interfaces. Much of it, though, is buried deep inside the machinery of modern finance. And that is precisely why regulators are now paying such close attention, because AI is not simply just another technology upgrade. It really does change the speed and the opacity and concentration of risk, and it can make financial institutions more efficient and more personalized, but it can also deepen third-party dependencies, it can amplify cyber threats, it can entrench bias and create model risk, and it can certainly accelerate market contagion. So, in a recent address at the University of Johannesburg, Fundi Tshazibana, Deputy Governor of the South African Reserve Bank and CEO of the Prudential Authority, set out perhaps the clearest articulation yet of how South Africa's financial supervisors are thinking about AI. Her message was neither technophobic nor breathlessly utopian. It was a lot more nuanced, thankfully. Innovation is inevitable. Prohibition is not a sustainable strategy. But financial institutions cannot outsource responsibility to the machine. The license holder remains accountable, the board remains accountable, and management remains accountable. The Prudential Authority and the Financial Sector Conduct Authority, the FSA, have already published their inaugural report on AI adoption in South Africa's financial sector, and the next step is a discussion paper expected in the second half of this year, with regulatory arrangements likely to follow shortly thereafter. Globally, the Financial Stability Board has also warned that AI may introduce vulnerabilities around third-party concentration and cyber risk, as well as model opacity, market correlation, and governance, which are precisely the issues that now sit at the heart of supervisory thinking. So today on the Monocle Banking Podcast, we are privileged indeed to be joined by Deputy Governor Fundi Tshazibana. DG, welcome. Your speech begins with the idea that AI is changing how supervisors look at the financial world. What has shifted recently that makes AI a prudential issue rather than just an operational technology issue for individual firms?
Thanks, Michael. What has shifted is the advent of generative AI, which is more autonomous. So in finance, innovation is not a new thing. I mean, if we think back to banking as we were growing up, we used to have bank books and ATM machines came. And there's a lot that has moved. And the financial sector has always been early adopters of technology. But a lot of that technology has been human driven, for lack of a better word. So there's always been a lot more human intervention. So as we've seen generative AI progress with large language models, as we've seen quantum computing take us miles ahead in terms of what is possible. And we've seen tools such as agentic AI that can make decisions. That is what is changing. And as financial supervisors, we always need to have a level of understanding of what it is that financial institutions are doing, how they are utilizing technology, how they're governing technology, how they're thinking about the data. And this is happening at the time in which also the information world is changing, right? The responsibility, the accountability, how financial institutions are using yours and my information as a proprietary tool for themselves. And so the combination of these factors is what is making regulators and supervisors wanting to understand a lot more what
Mm.
is going on beneath the hood, for lack
Mm,
of a better word.
absolutely. I mean, even when I chat to bank executives, many of them say that they are hesitant to deploy a model if they can't explain it. And some of these are already black boxes as they are. You make the important point that financial supervisors aren't there to be the ones identifying the most exciting applications of AI. That's really for the institutions. Would you say the core supervisory concern here is that AI creates new risks or that it accelerates and disguises the familiar risks, credit risk, operating risk, conduct, cyber, and that kind of things in ways that are harder to observe?
Yeah, it can amplify those risks. So, the way that one should think about innovation is it can be an amplifier of risk, but it can also help to leapfrog, right? Innovation and help us in multiple ways. So, when we think about AI and the possibilities, so when we think about ourselves as financial customers, one of the barriers that result in financial institutions not lending to an individual is they don't know enough about the individual. At present, the credit decision is based on the known credit history of that individual. It's based on whether that individual has got collateral, it's based on their income level. If you have an AI system that's able to pull multiple data sources and look at an individual differently, their consistency in making payments, they look at other products that they potentially have, that gives you a very different profile to that customer. Now, that does help us from an inclusion point of view. And this is why we have to be balanced as financial sector supervisors. We have to recognize that there are opportunities from an inclusion point of view, but there are other amplifiers of risks in terms of potential credit risk. If there is model bias, there is reputational risk to the financial institutions. If things go horribly wrong, the cyber risks can amplify system wide risks across many financial institutions. And of course, there's the concentration risk that exists because there are so few third parties that are providing the service. So, do you end up with financial institutions making the same decisions and us as a country getting exposed
Mm.
because many financial institutions have been now subjected to whatever the underlying bias was in the AI system itself. So I would say that they are system enhancement because more inclusion is better for the system. It makes for a stronger financial system. It makes for a stronger economy, but there are also these risks that we need to find the right balance.
It reminds me of last year's flavor of the year, which was third party risk. And financial institutions need to be aware of the concentration issue when it comes to assessing things like third party risk. No, this year it's the effectiveness of AML and counter financing of terrorism and counter proliferation of financing controls. And I think there's a big question mark that's been raised here. And you opened your speech with what you called the Mythos moment. And for those who don't follow AI that closely, this is this new frontier model by Anthropic. Why did that example matter so much to supervisors?
So this example mattered to us. So, I'm a great fan of novels. And one of my favorites is one called Origin by Dan Brown,
Yes.
where the AI ends up being the rogue. The AI kills the guy, right? That's what happens. There's a murder, there's this that's happening, you get maximum coverage. Anyway, so that's not the point. But the Anthropic story was almost an acceleration of the way that we had been thinking about agentic type AI. So when you think about the frontier models and what they're able to do in terms of taking instructions, they can evolve on their own. And I think the risk here was about how this particular model could potentially accelerate cyber risk. And the important message by Anthropic itself was there is a risk in this model if you make it available to the general public. Because if you are able to achieve a system breach, there's no knowing what else can happen, right? So if we think about all major systems, our phones have got operating systems. There's massive risk that relates to potential operating system risk. And the fact that if you were to have something like this and some bad actors get hold of it, what would it mean? And from a broader financial stability sense, one needs to understand that there's a lot we don't know about how cyber risks can materialize and at scale and how much exposure there can be. So, the closest example we've had was the patch issue that related to CrowdStrike that we had to deal with in the most recent past, where multiple institutions were affected, right? It was banks. It was stock exchange. It was airports. It was some airlines. So just to think about the system-wide effect. And I think that's what the Mythos model sensitized supervisors to say that we need to have stronger conversations with financial institutions so that they understand their exposures. There's also the matter of the time of how long it would take to achieve a system breach. And there's an interesting chart that I have seen that looks at how long it would take to breach a system. It appears to have moved from years to days, and
Sure.
now we're talking a number of hours. So, how long might it take for a system to be breached, and how long it would take for a financial institution to ready itself to respond? And that was the reason why financial sector supervisors had to take notice of what Mythos was saying.
One doesn't want to be overcome by hyperbole or an unnecessary panic here. And supervisors are not prone to panic, central bankers, especially, as you put it. But one has to update one's worldview given this. And it's interesting, last year at the Gibbs Beyond Banking conference, I was hosting a panel of senior executive bankers, and we put up a list, a poll for the assembled delegates to say, what are the things keeping you up at night? Is it low growth in South Africa? Is it political instability? Is it the return of inflation, interest rates? And the last option was cyber risk. And unanimously, every single banking executive said cyber risk is the one thing keeping them up at night. And it is because of this rapid advancement that we're seeing from bad actors. Because at the same time that AI can help defenders find vulnerabilities, it can also help the attackers. We've seen a sharp rise in digital bank fraud in South Africa. In your speech, you note that reported digital bank fraud incidents grew by 86% between 2023 and 24. What potentially does AI do to that trajectory? And how do we start thinking about, as executive teams at banks, how we stress test for cyber risks and to stress our systems to see that we're resilient enough against these attacks?
So, Michael, financial institutions already run multiple stress tests that they have to, because what we are all finding is that there are multiple attempts on financial institutions, including central banks themselves, daily, hourly, all the time. So the fact that someone's going to try and get into your system is something that is inevitable. It's already happening. What is important is to strengthen the defense mechanisms to make sure that there is no breach, or if there is a breach, it is detected immediately and there can be domain take back. And so financial institutions invest a lot of money annually in getting their defense systems right. That entails them having to find some friendly hackers. You need to know how hackable your system is. You're not going to know if you're not hiring experts who are able to do this to run your breach detection system. It also means that as you discover fragilities, you need to patch those up almost immediately. So the teams behind the scenes are doing a lot of this work. The second is understanding the vulnerability at a system level. There's been a lot of maturity, I would say, among financial institutions in layering their systems because one, they need to protect their customer data. Two, they need to protect the institution's data itself. And there are multiple ways when there has been a data breach that the vulnerability can materialize. It is important that that information gets reported to the board of directors of the financial institution so that they can take the right decisions. There are financial decisions in this regard. It also affects the access and the permissions that you give to third party providers. So institutions need to understand the multiple ways in which breaches can happen. Because, in the same way that in the physical world, we have doors and gates to property, it is the same in the architecture of technology. So, understanding the architectural makeup of the organization, understanding where are the weaknesses, and having a layered approach, this is something that financial institutions are working very hard at. But having said that, there is a material difference between well resourced, large financial institutions and smaller institutions that are probably not as well endowed financially and in
Mm.
terms of expertise. And this is where we come in as supervisors in terms of giving broad guidance in saying to financial institutions, as you make the decision, understand the risk and you need to capacity yourself for the risk, because sometimes things look good, they look very easy, but you don't know what are the risks that a new package is going to come up with, a new system is going to come up with and present to the institution.
Yeah. And for example, cyber stress testing to include an AI enabled attack scenario, for instance, an attack on a shared cloud provider or a core banking vendor or payments infrastructure. You've got to model these things out. And it comes to, one of the 5 vulnerability categories you highlight is that third party dependency. There are only a handful of firms globally capable of building and running frontier AI models. And I know banks and insurers have long outsourced technology functions, but AI feels different because the model may shape decisions, not merely support systems. So, how should supervisors think about that distinction? And what does good third party AI risk management look like? Is it enough for a bank to say, oh, we use a reputable global provider, or does the institution need genuine technical capacity to interrogate the model and its outputs?
Yeah, so Michael, in my speech, I talk about the level of humility that we need. And this is very important because here we are all learning. So, at a global level, there is a conversation that we're having as financial sector supervisors and central banks around what it is that we need to understand and the level of engagement we ought to be having with the AI providers themselves so that we understand what's going on. The reality is, when there are large firms, and this applies to cloud services and other types of technology services, where there are few global firms that are in particular jurisdictions, there is very little leverage that we have. So when you are the one that requires a service and there are 3 service providers, they will all tell you, take it or leave it.
Yeah.
And when it's a take it or leave it scenario, then how do you think about it? The people who are takers might be frontier movers themselves, right? And we have very few companies that will have that level of negotiating power. So, from a third party risk management, I think globally is where the concentration is. If you think about the size of South Africa, we are quite small. We are a G20 country, but we are very small. So, we have very little negotiating power. But the negotiation must come from financial institutions in terms of the domain access they provide, in terms of understanding what it is that they need to have in their ecosystem. Now, at the point at which they are doing the shopping for the technology. And that is what they can control at this point in time. In terms of what else needs to be done, there is a global conversation to be had with these AI developers, because where we are going to find ourselves is we will have financial sector outcomes that are not owned by the financial sector itself, but owned by others in the financial sector. But it is not a simple exercise, because if you go to a technology provider, they will say, well, you can't supervise me. You've got no authority to supervise me.
Yeah.
And how do you manage that conversation? So, at a global level, we are having these discussions and we are also learning a few
Mm.
things ourselves, which is why when it comes to guidance for AI, we are calling it guidance. We cannot be rules based because there's so much more that we are understanding. There is a lot of nuance in terms of managing the relationship between the providers and the users of AI that we still need to navigate at a global level as well. So you'll see a lot of work coming through from the Financial Stability Board and the global colleges of supervisors that are talking about AI in a learning type environment. Very different from the way that you've seen rules coming across because we're still learning.
Yeah, and that humility, as you mentioned in your speech, needs to be kept throughout that process because it almost is. It's become analogous to the too big to fail problem. Except this time, the critical entities are not the banks necessarily, but the technology providers, which sit outside the traditional regulatory perimeter. So I just want to move on to the black box problem, explainability, bias, model risk, all of those things. Obviously, the AI models are capable, but they can hallucinate. They reflect their training data. They could possibly be biased, and their workings can be mysterious, even to their creators. So, how does a supervisor regulate a black box? And in things like credit scoring, insurance pricing, or claims decisions, explainability isn't an academic issue. It affects people's lives every day, whether they can access credit, get that home loan. What level of explainability should be kind of non-negotiable for high-impact financial decisions?
Phew. So, Michael, this is a decision that needs to sit inside the financial institution. So for us, the credit scoring, remember, the financial institution already does it. It's already being done by humans at present. So what is changing is that potentially outsourced. Now, the BIS had a very interesting presentation probably about 2 years ago. We were discussing how one thinks about AI as an iceberg and the fact that you take the good, the bad, and the ugly that comes with AI. So financial institutions have to be continually testing. They have to understand the biases. That means that behind the AI, you need to have a governance mechanism within the financial institution. And that governance mechanism will start with the underlying data that you put into the AI and then the outputs of the AI and understanding what happens. And it must be tested endlessly by the humans at point of introduction and during intervals. So this issue around explainability is the role of certain individuals within financial institutions. What we might have to consider as financial sector supervisors is whether this becomes designated and ends up belonging to a specific executive who is held accountable in terms of getting this done. But there are internal audit functions that are to help financial institutions. There are experts that financial institutions should be getting to assist them in testing the explainability of their models. They must also be auditing whether this is happening in that way and also have this constant interaction with the developer of the AI as they are discovering flaws and mistakes and problems. But how you pick up mistakes and problems is through the testing and the assessment. And this is not just unique to AI as we have it now. You even see it with macroeconometric models, right? So you have an MPC decision that you have to make. You're testing something, you're using a proxy number, but you see some strange correlations in the data. And that's how AI also has to be tested to say, what do you do when you see strange correlations in the data? What are the types of things that you need to correct? And what are the particular signals that you look for that this is potentially a hallucination? But there needs to be a human on the other side assessing those and guiding at point in time and having these periodic stress tests that relate to AI as well. And so in our space, we stress a lot the importance of model governance within financial institutions, the auditability of the model elements and the testing. And that's what we hold the financial institutions to account to us on. Now, that's the prudential side. Now, the Financial Sector Conduct Authority and other financial supervisors might be looking a lot more closely at the outcomes. But those outcomes that have got implications for financial institutions are what the boards of these institutions ought to be seized with, right? Because there's potential reputational risk, there's potential harm to customers. So the consumer duty elements also need to be taken into account. And as I said, those things are the responsibilities of the humans. We're not going to interview the AI and say, what has happened here? Why is there this biased outcome? And that's what the humans have to be vigilant about in terms of what they have to account for.
Who inside financial institutions should own model risk for AI? Does it sit with the CIO, the chief data officer, the board risk committee, or a dedicated accountable executive?
Yeah, that is evolving. So at present, you have mixed models, but you will have a chief information and technology officer in a financial institution. Sometimes those responsibilities sit with a chief operating officer. So we've got different models that we've seen across financial institutions. At board level, the risk elements sometimes sit with the risk committee, sometimes they sit with the audit committee, but we're seeing different design. But there's a board subcommittee that would normally look at model governance, and that's the direction that we are taking financial institutions. Some of them have already renamed those board subcommittees as model and AI risk governance committees. But this is an area that financial institutions themselves are learning. And so we are focused on ensuring that within the board, there has to be a technology expert or someone with experience on technology use, because it is not only impacting the structure of the organization, but also the finances of the organization as well. And whether that's embedded within the risk committee or the audit committee, between those two committees, this work needs to be done. But we continue to refine, Michael, with time as we're assisting financial institutions to have or to mature in this area. But below the board level, we also need to have governance structures that dictate what happens. In the banking space, there is a standard that has been set by the Basel Committee on data aggregation and governance, which is a standard that assists and informs financial institutions what they have to do. But that is like step one, as I said, the data governance layer, and then there's the tech governance layer, and then you then overlay, because AI is also not one thing. So if we think having a single structure that looks at AI is going to help, that's not the way.
Yeah.
So it requires a whole of bank or a whole of insurance or a whole of system approach, because as I say, there are the elements that relate to third party risk, and that needs a governance structure. There's the tech elements, there's the data elements, and then there's broader governance. But all of those things need to be integrated together with the financial implications, of course, and the people elements, the capabilities that you need to have to manage the AI.
Just as we reaching the end of our time, Deputy Governor, on regulation, you say that the PA and the FSCA discussion paper is likely in the second half of this year, with regulatory arrangements probably by early next year. What should industry expect from that process broadly?
Yeah, so I think in that discussion paper, we'll be reflecting on what is our approach. At this point, it looks like a principle-based approach is the best guidance. We also would need to look at the integration or the interaction of different standards that we already have in place. As I say, AI is multi-layered, and that's what the discussion paper is going to guide, so that industry understands our direction of thinking. But this is an area that is unique in that we will have to work together. We still need to build understanding. And so we're thinking about having a paper that also recognizes the areas where we have to learn from each other as well.
And for yourself as a regulator, you spoke about skills broadly in the sector, but what kind of supervisory talent does the Prudential Authority now need? Do you need more data scientists and cyber specialists and model validators and all of those kinds of things in order to continue to be an effective regulator?
We certainly need to have the skill set, not only to understand what financial institutions themselves are doing, Michael, but also for us to move, because we also need to mature the way in which we are using technology. So if you're going to be receiving AI generated reports, you certainly will need to have the mechanism and the means as a supervisor to be trawling through that. So our own investment in AI, how we're thinking about internal AI use. I mean, this is a whole other topic, by the way, that we
Yeah.
should spend time talking about in terms of the use of AI within public institutions as well. Because in the same way that we're talking about AI use governance in financial institutions, we also need to be reflecting on what our staff are doing and how we ourselves are utilizing AI.
Very good point. I would love to have you back on discussing exactly that. Thank you very much. That was Fundi Tshazibana, Deputy Governor of the South African Reserve Bank and CEO of the Prudential Authority, and perhaps the defining regulatory challenge now emerging in finance: how to capture the productivity, the inclusion, and the risk management benefits of artificial intelligence without allowing the black box to become an accountability vacuum. You're listening to the Monocle Banking Podcast.